Welcome to The Explainer. Today, we're tearing apart DraftKings Q2 2026 earnings report, and let me tell you, there's a massive paradox hiding right in plain sight. It's this wild story of explosive user growth crashing headfirst into a wall of declining revenue, all while the company spends a literal fortune trying to pivot into something totally new. If you want to understand the modern economics of online betting, you are absolutely in the right place. Let's get into it.
Okay, so let's start by looking at the immediate market reaction to these numbers. The stock actually jumped 4.6% on Friday, closing at roughly $26.17. But, and this is a pretty major caveat, look closely at the trading volume. Only 8.4 million shares actually changed hands. That's about 35% below the 20-day average. So, what does that tell us? Well, it means we probably shouldn't automatically interpret the stock bump as massive institutional conviction. The market is definitely hesitating.
Now, let's unpack the financial mystery right at the heart of their quarter. DraftKings saw their sports consumer volumes surge by 15% to a staggering $13.1 billion. I mean, more betting activity, right? Sounds fantastic on paper. But revenue went in the exact opposite direction, falling 5% to just over $1.4 billion. Seriously, how can betting volume surge while revenue actually falls? Well, management pointed to customer-friendly sports outcomes and heavy reinvestment in promotional spending. It's a total contradiction, and it brings us to our first main point.
Section 1. The growth contradiction. More bets, less revenue.
So here's the crucial friction point we need to talk about. DraftKings is acquiring a lot of customers. Monthly unique payers went up 9% to 3.6 million. But the average revenue they're actually making off each of those pairs, that dropped 13%, sliding from $151 down to just $132. Are they successfully building a massive, valuable user base, or are they just kind of buying growth and attracting customers with deteriorating near-term economics? To figure that out, we have to look at their latest marketing tactic.
Section 2. The $150 promo experiment customer economics test.
Right through August 23, 2026, DraftKings has been running this massive promotion. Basically, a new customer puts down a qualifying first predictions trade of at least $5, and bam, they get $150 in predictions dollars. It's literally the equivalent of a casino just handing you chips for walking through the front door. But make no mistake here, this isn't free cash you can just withdraw to your bank account. It is promotional credit tied strictly to DraftKings' new predictions product.
And as you might guess, that kind of push comes with an absolutely astronomical price tag. Just take a look at this number. $322.5 million. That was DraftKings' sales and marketing expense for the second quarter alone. That's a massive 38% jump year over year based on current reporting. It's the steep cost of chasing growth for sure. Promotions of this scale aren't just marketing, they're a direct financial investment. And the whole thing relies on one core mathematical formula.
Section 3. The acquisition equation, cost versus lifetime value.
At the very heart of the online betting industry is the lifetime value model. The logic here is that a sportsbook can spend really heavily today to acquire a new customer, basically assuming that the customer is going to generate revenue for years to come. As long as the customer lifetime value ultimately exceeds the acquisition cost, hey, it's a win. So DraftKings is actively subsidizing users right now for a future payoff.
And these numbers brilliantly illustrate just how aggressively they're playing this game. Look at these verified Q2 metrics. Customer acquisition was roughly 75% higher year over year. They acquired about 30% more customers than they originally planned to. They even invested 10% more into acquisition spend just because they saw such strong demand. And interestingly enough, management noted that their underlying Q2 customer acquisition cost, or CAC, was actually about 25% better than anticipated. So they aren't just passively collecting revenue, they are deliberately buying up market share. But what exactly is the end goal for all these new users?
Section 4. The super app pivot beyond sports betting. You see, DraftKings is no longer just trying to be a sports book where you throw $5 on a football game. They're evolving into a true super app. The grand vision is a fully integrated digital sports, gaming, and prediction markets platform. They want to completely flip the script on why a customer might open their app, shifting them from occasional sports betting into daily, habitual engagement. The absolute centerpiece of this pivot is DKeX. It's a proprietary prediction markets exchange they launched nationally back in June. The idea here is simple, but it's super powerful. Instead of just betting on who's going to win a game, users can trade contracts based on real-world outcomes. We're talking sports, of course, but also politics, financial markets, and even crypto prices like Bitcoin and Ethereum.
By doing this, DraftKings is jumping right into an incredibly crowded and competitive prediction market war, going head-to-head with specialized platforms like Kalshi and Polymarket. Now, if you're sitting there wondering if people actually use this, well, just look at this metric. At the DKeX launch in June, DraftKings said its predictions offering had already generated approximately $3.4 billion in annualized consumer volume. $3.4 billion. That proves this isn't just some experimental side project. There's already substantial consumer activity, and management really believes this can become a major incremental growth engine. But, eventually all this spending and pivoting has to face the music.
Section 5. The ultimate valuation test. Growth versus profitability.
Despite that revenue dip we saw in Q2, DraftKings maintained its 2026 guidance. They're still expecting full-year revenue somewhere between $6.5 and $6.9 billion, and they're projecting adjusted EBITDA between $700 and $900 million. When you compare that massive full-year target to their Q2 adjusted EBITDA of only about $115 million, you can clearly see the immense scale they are banking on by year's end.
And here is a critical distinction that management really wants everyone to understand. Their core sportsbook business actually remains on track for approximately $1 billion of adjusted EBITDA in 2026. The consolidated numbers we just looked at, those actually reflect the continued, really heavy investments they're making into the new predictions business.
So, as an observer, you really have to weigh two completely opposing futures here. In the bull case, DraftKings keeps acquiring customers, and more importantly, those customers actually stick around. Predictions becomes a massive revenue stream. Lifetime value far exceeds acquisition costs, and earnings scale rapidly. If that happens, today's aggressive promo spending looks like an absolute genius investment. But over in the bear case, we see kind of a nightmare scenario. It's a perpetual cycle where promotions just have to become more and more aggressive to fight off competition. Customer acquisition costs rise, revenue per pair stays weak, and regulators potentially step in with new restrictions. It basically becomes a heavy investment drain where they are just endlessly subsidizing disloyal customers.
DraftKings is running a live hundreds of millions of dollars experiment in customer economics right before our eyes. And I want to leave you with this final provocative thought. As they transform into this super app, is the future of DraftKings determined by simply how many customers it can attract through flashy promos, or is it determined by how much each of those customers is ultimately worth over time? Because if it's the latter, that $132 revenue per pair metric we talked about earlier might ultimately matter a whole lot more than a one-day 4.6% stock rally. Thanks for joining me for this explainer. Keep your eyes on the data and keep learning.